Hi, I'm Lucas from Quant Monitor. Today I want to show something simple but important. Trend following didn't begin with indicators. It began with observation, long before moving averages, oscillators, and filters. Trend following did not begin with indicators. It began with observation. Long before charts were filled with technical tools, market participants already recognized trends. They didn't calculate them, they experienced them. They watched prices advance, correct, and advance again. They watched declines persist despite rallies. They learned that markets either had the ability to continue or they didn't. And that persistence, not up or down, was the defining characteristic of a trend. Indicators didn't create trend following. They appeared later as attempts to formalize principles that were already understood. Before indicators, trends were identified through structure and behavior, not computation. Early traders didn't ask, is price above the 200-day average? They asked simpler questions. Is the market able to continue after a reaction? Do declines attract buying or more selling? Does strength persist over time? A trend wasn't a signal, it was a judgment about market condition. And here's the crucial point. Direction alone does not define a trend. Markets move up and down constantly, and most of that is noise. A trend exists only when price demonstrates continuity through time. Persistence separates noise from structure. An uptrend is not defined by rising price alone, but by repeated ability to absorb selling pressure and then resume higher movement. A downtrend is defined by the opposite. Rallies fail to attract sustained demand. Original trend following was about identifying which side repeatedly failed. Time was the earliest and most reliable trend filter. A movement lasting hours was considered speculation. A movement persisting through days or weeks commanded respect. The longer a market maintained its character, the more credible the trend became. Time filters emotion. Short-term enthusiasm can lift prices briefly. Only sustained participation can carry a trend forward. Early practitioners understood trends require endurance, not urgency. If a move could not survive time, it was not a trend. Pullbacks were never seen as threats to a trend. They were tests. In an uptrend, occasional declines are expected. What matters is how the market declines. Does selling accelerate and spill into panic, or does price stabilize and attract renewed demand? Pullbacks reveal whether participation remains committed. Corrections are informational. They expose whether the dominant force has weakened or merely paused. A trend that survives pullbacks gains credibility. A trend that fails during minor reactions reveals fragility. So trend following was inseparable from observing how markets behave under pressure, and without indicators, trend strength was inferred from behavior. Strong trends often show shallow corrections, quick recoveries, increasing participation over time. Weak trends often show prolonged reactions, failure to resume direction, loss of follow-through. These observations require patience, not calculation. And in a way, the absence of indicators can increase insight because it forces deeper engagement with market structure. Before indicators, exhaustion wasn't identified by divergence, it was identified by a change in character. Markets that once advanced smoothly begin to struggle. Corrections deepen, recoveries weaken, time spent advancing shortens, while time spent correcting expands. A trend often doesn't end suddenly, it degrades, and that degradation is visible when you focus on behavior, not levels. When effort increases, but results diminish, exhaustion becomes likely. Trend following never aimed to call the exact top or bottom. It recognized when continuation became increasingly difficult. So why were indicators invented? Indicators were created to simplify judgment. As markets expanded and participation broadened, direct observation became harder. Indicators offered shortcuts, approximations of persistence, momentum, and exhaustion. They transformed judgment into calculation. But this came with a cost. Indicators abstract markets away from context. They replace observation with thresholds, and trend following can shift from understanding to execution. That leads to two different styles. Structural trend following is interpretive. It considers time, behavior, participation, persistence. Mechanical trend following is procedural. It relies on predefined rules, fixed thresholds, delayed confirmation. Both can work, but they are not equivalent. Structural approaches adapt naturally as conditions change. Mechanical approaches often require recalibration. Early trend followers practiced structural trend following because mechanical tools didn't yet exist. Now, what do modern traders often get wrong? The most common mistake is equating trend following with indicators. Moving average crossovers didn't invent trend following. They codified one narrow aspect of it. When traders confuse the tool with the principle, understanding is lost. Another common mistake is chasing early entry. Early trend following valued confirmation over anticipation. A trend that required prediction was considered unreliable. Patience wasn't a flaw, it was protection. And finally, why does trend following still work? Because its foundation is behavioral, not technical. Human behavior hasn't changed. Fear and greed still operate. Participation still clusters. Persistence still matters. Indicators evolve. Platforms evolve. Execution evolves. The principles remain. And the final reminder, indicators do not create trends. They describe them. They lag because understanding lags experience. By the time a trend can be measured, it has already proved itself behaviorally. Early trend followers accepted this delay. They didn't seek perfection. They sought alignment. Trend following was never about catching the beginning. It was about staying with what proved itself over time. Conclusion. Before indicators, trend following was a form of market literacy. It required patience, observation, and respect for time. Indicators can assist this literacy, but they cannot replace it. Understanding this is not a step backward. It's a return to first principles.